Hello and welcome to the video. In this video, I will take you through the PMS Distributors Certification exam, which is also known as Series 21A exam. In this video, I will take you through the chapter 4, which is about investing in fixed income securities, right? So, fixed income securities is an area where many people do not have that kind of a familiarity as they have with equity products because equity is spoken more frequently than fixed income products. So in this video we'll discuss about this fixed income securities. Okay, and the fixed income securities basically is type of security. Okay, which is having periodic income in form of coupon and return of principal on maturity. That's how we identify. But as I said, the textbook here also tells you, a reference book tells you that a typical investor has more focus on equity when it comes to investment decisions. That's a fact, right? Nobody can hide this. um, it is an irony with the textbook or the reference book again says because the global total market value of bonds is larger than the market value of equity. Now, this is very interesting. Please take note of this aspect as well. Generally, government is the single largest issuer of bond, which is a fact again because government is a borrower, right? And it's a huge borrower. Not only the size, but also in terms of number of issues. Bond market overtake equities as unlike equities, companies can issue many different bond outstanding at the same time. So equity is only one, maximum it can be common equity and preference shares, but there's not much difference beyond that. And when you issue equity shares, you just issue one type of equity share. Bonds you can issue at different time, different features, different maturities, different coupons and all that, right? In India, fixed income market is classified on the basis of entities issuing it, and they are issued by different entities, right? So these are the entities which issue it typically. Okay, uh, so we have the government, which is state and central, public bodies, banks and institutions, statutory corporations, and other corporate bodies. Of course, please note that recently even municipal corporations have started issuing bonds, and the market for that has started picking up. So you can see here the same has been put in a tabular format. Okay, government security is the largest constituent. Now, this is very important to note again because you may have question in the exam asking who is the largest issuer of these securities. Now, so you if you know this aspect, it will be helpful. The next largest is rupee denominated corporate bond market, right? So after that, government securities, we have corporate bond market. This is the sequence, right? Uh, Corporate bond markets are typically placed privately, okay, uh, and the buyers are the wholesale investors. So you don't have a lot of public issues. In fact, one data suggests, which is not mentioned in this material, is that 99% of the bonds are privately placed. Uh, because of the private placement, retail investors do not get much opportunity to participate in this market. The issuing and trading of fixed income securities by each of these entities are regulated by different bodies. Government securities and securities issued by banks and BFCs are regulated by RBI, and non-government securities obviously are regulated by SEBI. So SEBI regulates corporate bonds, even municipal bonds, right? What is the characteristic of bond? Something which I have already said. It pays a fixed amount of coupon and repays the fixed amount of principal on maturity. This is how we identify a fixed income securities as, because fixed income security, when you buy it, you pay to the issuer an X amount which is returned on maturity, and issuer pays you coupon periodically. Okay, the periodic payment of coupon could be mostly semi-annual. Sometimes it can be annual, exceptionally quarterly, and very rarely monthly also, right? So these are the frequency of payment that you have, but mostly it is semi-annual. Government securities are semi-annual and it is based on the face value. Okay, there could be bonds which do not pay you coupon. We call these bonds as zero coupon bonds which do not pay us coupon. You only buy, it for a amount and you receive face value uh, on maturity. So you buy it at a discounted price compared to the face value. Face value may be 1,000 and you have bought it at say 500 example. Okay, uh, bonds have fixed maturity date. However, you may come across perpetual bonds. Okay, perpetual bonds do not have maturity. The name perpetual itself explains it. On the basis of term to maturity, bond with a year or less than a year term maturities are termed as money market, and the longer term ones are termed as capital market. So anyway, money market is a market for short term securities having maturity of less than 1 year, and capital market is the market with securities having maturity longer than a year, right? Bonds will have typically different features: issue price, coupon, maturity, face value, redemption. These are very important. Okay. Issue price is the price at which a bond is being issued, which is typically face value. Okay. But it can be higher than face value and lower than face value also, especially for government securities. Okay. Coupon is a feature of every bond which indicates the regular income that you will get from a bond. Okay, and this is something which is what is the periodic cash flow for the investor. The term to maturity is the time period before a bond matures. Okay, it depends upon different types of bonds. G-Secs are coupon bearing; they pay semi-annual coupon, and the tenure may be between the range of 5 to 30 years. Now, this is very important point to note that G-Secs have maturity up to 30 years, typically between 5 to 30 years. Okay, and you know, you get coupon which is semi-annual. This is important. Face value is the value is like, it's like a currency denomination. Okay, face value may be different from bonds price, which I have already said, because a bond may be issued at face value, can be issued at a price less than face value or more than face value. Okay, that's the point that we need to know, and this is because of the reason that the market interest rate keeps on changing. Okay, so we may have a discount bond, or we may have a premium bond, right? And a par bond. So there are three types of bonds: premium, par, and discount. Now please note that this classification is there because of coupon and the yield. Okay, so when coupon and yield are same, it's a par bond. When coupon is higher than the yield, then it's a premium bond, and when the coupon is lower than the yield, it's a discount bond. Okay, it's a known fact that market interest rates and the bond prices have an inverse relationship. That is how we look at it, right? Now, when the interest rate in the market increases, the bond price will decrease, which is a fact, right? Now, when you buy a bond, you have to understand that uh, there are certain interesting aspects which may come into play. Okay, like you can see here, another interesting thing about bond is that unlike equity shares, government or companies can have many different bonds outstanding at the same time, but each of them could have a different maturity period and coupon rate. These features of the bond will be part of the bond indenture. Now, indenture is a word, and indenture explanation has been given. Indenture is a legal agreement between two parties. In case of bond indenture, two parties are issuer and the subscriber, or the lender. Okay, that's where the indenture comes into play. I hope you are getting the concept so far. Okay, you can also get bonds with option. Bonds could have call option. Call option gives issuer the right to call back the bond. Okay, which means a bond may have maturity of 20 years, but the issuer may call it back, say after example, 10 years. Okay, there have been many bonds which have been called back. Okay, and like SBI had issued a retail bond in 2011 for 15 years. It called it back in 2021, which is after 10 years. Just as you have a call option, you also have a put option. So put option gives the bondholder right to sell the bond back to the issuer at a predetermined price on a specific date, correct? And apart from call and put, we also have a convertible bond. Convertible bond is a bond which can be later on converted into equity shares. So the bond gets exchanged with equity shares, right? Now, what determines the safety of a bond? Okay, it's very important because when somebody buys a bond, okay, it's important for the buyer to understand the safety aspect. So, say safety aspects of bonds are basically tied to the probability of default of the issuer. That's very important. Okay, and that is why there is a very important risk in the bond which is called as the credit risk. Now, credit risk is what we need to know. So, credit risk is the risk of loss resulting when the issuer fails to make full and timely payment of interest or principal. That's important thing for us to know. Most important document to understand the safety of a bond is its indenture, right? So indenture is what you need to go through. I've already explained what is the meaning of indenture. Okay. All features of bond, par value, coupon rate, maturity, periodicity of coupon, collateral, security, everything is listed down in what is called as indenture. Okay, so indenture is what will give you all these aspects, right? Now, point to be noted is that there is something called as covenant. So covenants are the clause which specify the right of the bondholders and restrictions on the bond issuers. So there is a covenant which is there, and covenants are broadly of two types: positive and negative. Positive covenants are action which issuers are required to do, whereas negative specify what issuers are prohibited from doing. Okay, this is very important, and these are necessary to protect the investor's interest. So, four things that you will note down here: one, the indenture; second, the covenants; third, the positive covenant; and fourth, the negative covenants. So all these aspects you have to remember in terms of questions that you may get in the exam. Okay, and sometimes what happens is that bonds are issued. Okay, uh, with security backing them, collateral backing them. We call such bonds as secured bonds, and if the bond is not backed by a collateral, we call them as unsecured bonds. The word secured is mentioned here, so you can, sorry, unsecured is mentioned here, so you can see this, right? To understand the probability of default, most bonds rely on rating agencies, and these credit rating agencies who are there, who are again a recognized entity. Okay, so these agencies give or assign credit rating after carrying out a detailed analysis of issuer's ability to honor the payments, right? So that's what they do because they have been kind of given this task as per the law. Okay, and the ratings are specified by SEBI. Okay, so SEBI has put that specification. The rating agencies have their own methodology and they use symbols, okay, to give the rating. The symbols can be like this, from AAA to D. Now, obviously, when you are triple A, it means there is the highest safety, but when there's a D, D indicates the default, right? So you can see the ratings like this: AAA, AA, A, triple B, B, C, and all that, right? All these ratings that you see very clearly specify what is the credit worthiness of the issuer. It's an opinion, of course, but then it says that instruments with these ratings are considered to have highest degree of safety regarding timely servicing of financial obligation. Right, that's what is AAA, correct? And then you have D, which is default. So things range between AAA to D, right? Now, credit rating agencies may also provide symbols for short-term debt instruments, which is A1, A2, A3. An instrument like commercial paper may be given this kind of a rating. If it is rated A3, what does it say? For example, instruments with this rating are considered to have safe moderate degree of safety regarding the timely payment of financial obligation. So that's what it is clearly indicating here, right? So you have ratings for short term as well as for long term. Now, bonds need to be valued periodically because when an investor purchases a bond, he needs to know what should be the price. And when the valuation is done, what we do is that we find out what is called as, uh, you know, intrinsic value of a bond, and it uses the discounted cash flow technique. This is very important. So discounted cash flow approach uses the required rate of return of the investor and discounts all the futures cash flow received from a bond to arrive at its intrinsic value at a given point of time. Now remember, in a bond, when you buy a bond, the cash flows that you will receive are nothing but coupons, right? So what you do is that you discount the coupons plus the principal amount that you will receive on maturity, right? So what will happen is investors, after knowing the price, okay, will take a decision whether to invest or not in a bond. Okay, so investment decisions in bond can be taken by estimating what is their intrinsic value. This is the method to find the intrinsic value. Okay, and basically investors look at the yield also of a bond, right? What is the yield that a bond is giving? Yield is nothing but kind of a return that the bond is offering. So your decisions will be based on yield. So one is basis intrinsic value, and second is basis what we call as the yield. This is the second factor. How do we arrive at the intrinsic value of a bond? There's a method to calculate the intrinsic value, and I'll just tell you what is that method briefly. You can obviously use Excel function. Okay, so in Excel there is a function called as a price, and there's a function called as yield. Okay, so what you can do is you can go to Excel, Microsoft Excel, and in Microsoft Excel, and please do remember that you may need to do this in exam also. So this is important that you know this part to solve the problem related to price and yield. So you will go to function here, fx, okay, insert function. In insert function, to be on safer side, you can go to financials, and then you can go to price. Price is the function, so price function comes from p. Okay, so we'll go to the price function and we'll see the price function here. So price is the price. So we go to the price function here. Once you go to the price function, then you will see values such as what is the settlement date of the bond, what is the maturity date, what is the rate is the coupon rate, yield, redemption, and then you scroll down from here and input frequency and the basis. If you do input all these parameters, you will get the price of a bond, which is what gives you an intrinsic value. Similarly, you can go to the function here and select the yield formula to calculate yield. Okay. So again, you will have to input values, and if you input values like what is shown here, okay, you will be able to get the exact answer. So if you can input the parameters here, okay, which are the parameters given as settlement date, maturity date, coupon, yield, and all that, and use the price function. Okay, frequency has to be 2. Day count convention, typically we will use 1, 2, 3, and 4 or something. If it is bond market, we use 4. If it is money market, we use 3. Right. So that's what is your basis. So we can use the basis to find out what is the price. And similarly, you can also calculate yield to maturity, which is YTM, using the same function that I showed you just now, which was the yield function. So you need to just input the values and you'll get the output. Please remember, there is a day count convention. So India, for the bond market, we follow 30 by 360 convention, which is important to note. Okay, and we follow actual by 365 convention for money market, right? So we have two conventions which are there, money market and the bond market conventions, right? You can also look at uh, decisions, which I have already told you that if the YTM is more than the coupon, okay, the bond is selling at a discount, which means YTM is higher than the coupon. So these are the three golden rules that you must remember all the time: how to find out a discounted bond, how to find out a premium bond, and how to find out a par bond. Okay, so when the yield and coupon are same, you have a par bond, but otherwise you will have a discount and a premium bond. The volatility of a bond, which is the next topic here, can be measured with the various aspects, of course. So we know that bonds prices and interest rates have inverse relationship. Bond price volatility it is inversely related to coupon. So bonds which have higher coupon show smaller percentage price fluctuation, uh, and bonds with lower coupon will show what you call as the higher fluctuation. So first aspect is the yield and the price relationship. Second aspect is the coupon. You should buy higher coupon bonds to have less impact. Okay, maturity also is a factor. So if the maturity is longer, the volatility is more. Okay, and when there is a increase or decrease in the yield, the price also gets impacted, right? But the impact is not same, right? Which means bond price movements resulting from equal absolute increase or decrease in yield are not symmetrical. Okay, a decrease in yield raises the bond price more than an increase in yield. This is one aspect that we need to know about the bonds. Okay, so these are the factors that help us to understand what is called as the volatility, right? So what is the meaning of volatility here? Bonds are exposed to interest rate risk, which means Whenever interest rates change, okay, the bonds price may change. If the interest rate goes up, the bonds price will go down, and vice versa. And there is a reinvestment risk which can also be faced. Okay, so what is the meaning of reinvestment risk? Reinvestment risk means that if you buy a bond and you receive coupon, if you're not able to invest the coupon at the same rate, which is the coupon's rate, then you will be exposed to what is called as interest rate risk. So, interest rate risk basically arises because of fluctuation in the market interest rate. While the coupon value remains same, market interest rate will keep on fluctuating, right? So, that's your interest rate risk, and that's what you should focus on. Then we have a concept of a duration. Duration is a measure of time taken to recover your investments of the bond, okay, in terms of present value, right? So duration is expressed in number of years. Based on the calculation involved, it is interpreted as weighted average time to recover initial investment in the bond. This is what is the definition of the duration, okay. So duration concept basically tells us how much time will it take for us to recover our investment in the bond. That's very important, okay. And duration helps us in also measuring the volatility, right? So what will happen is that we can find out the duration of the bond, and bonds with greater duration, okay, will have higher volatility. So duration is something which can be calculated again in Excel, as I have showed you. All these formulas are inbuilt into Excel, right? So you can go to Excel again and go to the function duration, okay, and input all the values, okay. So that's how you find out what is the duration. The duration comes from the formula here, right? So you can use the concept of duration, right? So we have duration here. So you use duration and you input all the values. Do not forget to scroll down. Okay, one important mistake that people do while calculating this is putting the right date format. So if you have to put 1st January, for instance, you write 01 space JAN space 2025. This is just an example, okay. And then what you do is you just press enter. You will automatically get the most ideal format that has to be used for the purpose of working on Excel, right? You can calculate it in the Excel, and you can arrive at the duration just as we did yield and the price calculation. And then using duration, you can further find out modified duration. So first duration was Michaelis duration. This is modified duration. So how do we find it out? So modified duration is nothing but Macaulay duration divided by 1 plus yield. Okay. So modified duration helps us to figure out the change in the price with the change in yield, right? So this is the formula: percentage change in price is equal to minus modified duration multiplied by change in the market interest rate, correct? So negative sign indicates that there is an inverse relationship between movement of interest rate and price. One when one goes up, the other goes down, right? So that's how you work on this. So you could get a sense of how to use three key formulas. Formula 1, how to calculate price. Formula 2, how to calculate yield. And Formula 3, how to calculate duration and modified duration. Just to help you quickly for one exercise, which will probably give you that understanding. So let us take this to be the settlement date. So we will work on a quick calculation here to show you. So we'll take settlement date. Okay. So let us take settlement date to be, say, randomly. Okay, we'll take one number, 17th Jan 2025. Now you are working on calculation of yield. Okay. Now suppose you have the maturity date. The maturity date also we will take as one date. Okay. So let us take this to be maturity date, 1st January 2035. This is the bonds maturity. Okay. We will take the face value as 100. Okay. So there is a face value of 100. We'll take the price. The price has to be, say, example 98.25. Okay. Then we'll take the coupon. Coupon. All these numbers we are assuming. You can put any number. Coupon is 7%. Okay, which is given per annum. Then the frequency we will take. Frequency that we will take is, say, 2, which means it is semi-annual. Frequency 2 means anything which is semi-annual is put as a frequency 2. And then we will take DCC, which is day count convention, as 4. 4 means 30 by 360 in Excel, right? So it's 30 by 360. Now, if you have to use the formula in Excel, what will you do to calculate? What are we calculating here? We are actually calculating yield here. So we'll go to function here in Excel. We'll say how to calculate yield. So we'll go here. We'll go to the function yield, put Y. We went to yield. We select the settlement date. Click here. We select the maturity date. Click here. We select the rate, which is coupon. We select the price, which is the price. We select the redemption, which is 100. We'll scroll down, go to frequency, which is 2. We'll go to basis, which is 4, right? And once we have inputted all this, what will we get is the yield, right? So we have got the yield as this much. Now we'll convert this from the percentage here, right? So we have the percentage and increase the decimal value. So we have got an yield of 7.24%, right? So this is the yield that we have got from the yield formula in Excel, which is again I'm showing it for your benefit. So you can use formula like this to calculate anything in Excel. You have to just input the right values. I hope this video was useful for you. Thank you for your valuable time.